Are we sitting on a ticking time bomb in the Canadian real estate market? Well, there's one thing that's flying under the radar right now. Fixed payments on variable rate mortgages. If you've got one, when interest rates were rock bottom, you might want to listen closely. So last week, all of the big banks released their earnings report, and it was pretty much boom time. But what does that really mean for those of you who have loans stretched over 35 years? If you're wondering where we stand on this, I've got some numbers for you. Here's the catch: the big banks are not allowed to issue loans with over 30-year amortization if they're uninsured. This means that all the loans I'm talking about are about to need to be brought down below 30 years. If they're not, the only solution will be to increase payments significantly, and I'm talking about up to 50% more in some cases. Now, coupled with the rising unemployment rate and possible recession on the horizon, we're looking at a pretty big problem where all we have now, most of these loans were taken out during the peak of the real estate market when everything was stretching from borrowers' capacity to the max. Many opted for the longest amortization period they could to make those monthly payments as manageable as possible. Now I want you to think about that for a second. Loans over 35 years in the high rate environment, that's a dangerous combo. But before we get into the deep into it, let's look at where we're at with these long-term loans. Data. A quick comparison. I've compared the Q2 numbers from earlier this year to the current situation, and while the numbers are improving, we're still not out of the woods. For instance, let's talk about RBC. They currently have $67.7 billion worth of loans that are over 35 years. Now, to be clear, these are not negative amortization loans, but they do have a very long runway, and all of them need to come back down to 30 years or less. Overall, we've seen 17% reduction in these types of loans across the board, which is a positive sign. But hold on, we still have $126 billion worth of these long-term loan products to work through. What does this mean for you? So, what does it mean for you? The average Canadian homeowner. If you're not one of these loans, you could be in for a shock when it's time to adjust. The payments are going to need to increase, no doubt about it. And depending on where you're at, the increase could be pretty steep. For those of you who locked into these long-term variable rate mortgages, this great deal may not feel like a burden. The question is, how are these loans going to weather the storm? That's something we're all waiting to see, especially with a looming recession and a job market that's looking shaky at the best. Unemployment and recession risk. That's another factor. The unemployment rate has increased year over year, and if we do enter into recession, things could even get more challenging. If people lose their jobs, the ability to service these loans become a serious concern. Remember, many of these loans were taken out at the peak of the market when borrowing power was stretched to the limit. And if payments do jump by 50%, as some experts are predicting, that's going to be a tough pill to swallow for a lot of homeowners. A positive sign, but not out of the woods yet? It's not all doom and gloom though. The 17% reduction in long-term loan products is encouraging, and it shows that some progress is being made. However, still got a long way to go. Over $126 billion worth of loans that still need to be adjusted. While that sounds like a huge number, keep in mind it spreads across multiple banks and thousands of homeowners, but for those who are directly impacted, this could be a life change. I'd love to hear what you think about all of this. Are you in one of those long-term variable rates mortgages? How are you planning to deal with the potential payment increases? Let me know in the comments below. I'll see you in the next video. Thanks for watching. Have a great day. My name is Kevin Baldwin.